Lob.
Morgendämmerung.
Dageraad.
Dawn. It looks different from different places and different angles across Europe. But it's also something universal as we look across our region and the world. This is also something true of Europe's property markets, which is why it's an apt metaphor for a market where we're seeing growing evidence of crossing thresholds into a new cycle for real estate. Here with me, looking at these European property markets, are my colleagues Dom Silman and Petra Blazkova. So what are these thresholds that we're crossing? Well, the INREV ODCE index in the latest quarter of data is showing total returns are positive. This is the first quarter of positive total returns after 7 quarters of declines. So a key shift, an inflection point. Similarly, UK MSCI quarterly data shows capital returns in Q3 2024 were positive after 8 consecutive quarters of declines. Combine this with data that LaSalle's asset management team has gathered on our own portfolio, comparing expiring passing rent to rent on our new leases. This is showing a 2.7% increase from that passing rent, which has tracked inflation already, and then adding another 2.7% to the new rent, which is evidence of this strength in occupier markets and a return to real rent growth that we've seen over the last year.
Yes, I think for ourselves, and actually for all types of risk asset investor, not just investors in property, closely related to inflation, a major threshold crossed in 2024 was the change in the monetary policy backdrop in Europe and the UK, and indeed elsewhere around the globe. So the fall in inflation, the return in inflation towards the kind of 2% target set by the ECB and the Bank of England meant that the European Central Bank were able to cut policy rates first among the major global central banks, followed by the Bank of England and by the Fed. As a result, for real estate investors, debt has become significantly more accretive. So point-forward leveraged returns are now flattered by the ability to secure debt on terms that reference swap rates that in the Eurozone are 200 basis points lower than the ones that we see in the UK.
Well, another related inflection point is on yields. Our prediction a year ago was that property types would start to see yields coming in, and it has started to happen now. Average prime yields based on a market pricing have stabilized. Notable sectors with decline have been German and Dutch logistics, as well as UK retail warehouses.
You can read more about these changes as the fog starts to burn off in this new real estate cycle in our Europe chapter of the ICE Outlook 2025, which is posted on the Insights page of LaSalle.com. An overarching theme for Europe in this update is the fact that we are seeing compelling strategies within each of the major property types. It is a long and varied breakfast menu. Crucially, we think a beds and sheds strategy is just too simplistic to really understand Europe today. That conventional wisdom has certainly brought an element of insight over the last decade, but we're entering a new environment where it's just too reductive for the complexity we're seeing. And that's highlighted by some of these relationships inverting over the last year. Consider, for example, London and Paris prime office rent growth. It's been significantly stronger than prime logistics rent growth in markets like Brussels and Madrid over the last year. Similarly, MSCI data shows trailing year retail returns in some markets like Stockholm and Hamburg has been well above residential returns in other markets like Frankfurt and Paris. These examples highlight why that beds and sheds approach is it's just not sufficient to understand what's happening today. Markets have wised up to the changes we've seen and priced in those changing expectations. We also know that the segmentation of the market is much more complex than just 4 or 5 or 6 major property types. To get our arms around that complexity, we use a fair value analysis approach, comparing required versus expected returns in nearly 100 different segments of the European market. And that helps us spot areas of mispricing and attractive value.
Seeing the European market to what it is means acknowledging that the European economic growth is likely to be weak. GDP was just below 1% in 2024. However, in the real estate world, this creates winners and losers. The degree of decoupling has surprised us, however. The underwhelming rate of growth has decoupled with real estate fundamentals lately. A lack of supply in central locations and polarization by quality seems to be the key driver here. GDP was positively correlated with rents in Europe between 2001 and 2019, but then it has become uncorrelated after the pandemic. The link between GDP and demand is also likely to be indirect when it comes to potential new US tariffs. These could weigh on overall GDP in Europe, even as a stronger dollar, and it can boost the student housing demand and international tourist arrivals and hotel demand in Europe.
So against that backdrop then, what are our European strategic recommendations for 2025? I think we wanted to give you 5 key points to take away. And the first of those is, don't forget a red umbrella. So at this dawn of European real estate's new day, what does the weather have in store for us? Should we bring sunglasses or an umbrella? Having access to both might turn out to be prudent. Recent experience has shown that real estate investors can guard against inclement conditions by allocating to credit, putting a proportion of assets beneath a protective layer of equity. That's your real estate debt umbrella.
The second point is to acknowledge that industrial location selection will be crucial. That is why in LaSalle we created Paths of Distribution score analysis, which helps us to follow the strongest logistics, demand, prospects, and location based on 10-kilometer wide location hexagons. Following these hexagons will be a very important element to the fast-changing industrial outlook. We favor logistic strategies that focus on top-scoring hexagons with the highest ranked markets in our fair value analysis. More often than not, they are in France, the Netherlands, and in Germany.
Our third theme is that retail is back on the menu. So Dan spoke of a breakfast menu of options facing European real estate investors in 2025, and for the first time in a number of years, we see a place for retail there. After facing stiff headwinds, including the rise of e-commerce and the COVID-19 pandemic, and after a number of false dawns, European retail has been through a long dark night. Looking ahead, we do now think that select retail formats look too attractive to ignore. This is a shift that we anticipated in the ISA last year, but with occupancy costs converging with logistics and the fall in inflation, as we've already mentioned, retailer profitability has been supported enough that we saw that over the past year, European retail rents were able to grow at their fastest rate for the last decade. That doesn't mean that all retail will necessarily work, and we think investors still can and should be choosy on retail strategies, given overall expected rent growth for the sector in aggregate still pretty low. And as Petra mentioned, GDP growth is expected to be pretty slow in Europe also. But several niche retail formats, including factory outlet centres across Europe and retail parks in France and the Netherlands, stand out to us as being particularly attractive.
The next theme is around who are the master adapters among various property types. And here we speak about European offices. European office markets are different in a global perspective, and we believe that they will lead the transformation of the sector. Rebalancing is not a distant future or for any next buyer. It is happening now. Across Europe, 1% of office stock each year has been repurposed into another uses for the last decade. The Europe's most desirable office locations is mid-rise and mixed use, making it different from the rest of the world. And it has also long created a flexibility of uses that can facilitate the rebalancing. Renovation strategies in central locations like Paris also allow investors to address demand of raising tenant expectations and low carbon intensity space. To give you an example, for instance, London City, where vacancies have declined for the last 5 quarters, and central Amsterdam are our top picks for stabilized offices, while we continue to expect subdued demand for commodity office space.
Our fifth and final strategic theme for 2025 we're calling a residential and living smorgasbord. So if retail is like a tasting menu of small niches of opportunity, the European residential or living sectors are more like a large Swedish buffet. Not really a single property type, European living is a large collection of subsectors, with widely varying cash flow profiles, pricing, risks, and critically in a European context, differing regulatory backdrops. So this makes sector selection within residential or living paramount. We use our fair value analysis, as mentioned by Dan, to build our conviction in specific locations and specific market segments. For 2025, we think that student accommodation in Spain and Germany stands out as being attractively positioned, and we also think that flexible living concepts such as co-living also make the case for an overweight.
Dom and Petra have described 5 strategy themes that are all reasons to be an early bird. And Europe offers its own take on the early bird, as captured evocatively in the French expression "L'avenir appartient à ceux qui se lèvent tôt." The future belongs to those who rise early. We believe the future does belong to real estate investors who take advantage of a return to attractive relative return spreads for real estate, as reflected in a historic comparison between go-forward expected returns and swap rates, which is now back above its long-term average in Europe. Please follow as we release the North America and Asia Pacific chapters of the ISA Outlook 2025 in the weeks ahead, and we hope you continue to watch and read.